everyone. Welcome to the Alpha Pension Group Retirement Recap, Fiduciary Friday. Here with me is Rob Milas, our Chief Investment Officer, and Mark Salamone, our lead consultant. So, Rob, yesterday was an update in the market, but overall it's sort of been a down week, and there's a lot of volatility based on this new stimulus package. So why don't you tell us what's happening?
Yeah, Rich, this week was definitely a week of kind of ping pong with the market, kind of up and down. No big moves either way. At the end of the week, as we look at the last 5 trading days, we were down modestly. The good news being that earnings season kicked off and we are off to a good start. A lot of beating of expectations by companies, and that's a good sign. On the flip side, we've got COVID-19 again rearing its ugly head in many parts of the country. But again, as we kind of look forward from the current news to kind of what's leading, we're looking at the Conference Board's leading economic indicators. And, those are slowing, again, kind of bad news. But what's happening is they're spreading out a little bit more. So there's a little bit more broadness in those indicators, which means that, there's a better possibility that the signal is actually true and the signal is positive. So again, this good news, bad news. And now, finally, last night was the final presidential debate. I think, today is probably the last day that of a possibility of getting a stimulus package done before the election. If it probably doesn't happen today or maybe even this weekend, then it's probably not going to happen before the election. So that's really what's in the news.
Well, thanks for that, Rob. And I'm going to continue your theme of good news, bad news. So first, I'm going to give you some of the bad news, which is the CBO, the Congressional Budget Office, recently updated their outlook for the federal budget, and this includes the pandemic. So from April, really the budget tripled negatively. So a $1 trillion deficit is now a $3 trillion deficit. But really, here's sort of what it means to you in the context of retirement. In April, it was projected that Social Security would run out of money in 2035. This new update says 2031. So in the past 6 months, we essentially lost 4 years. And really, the only recommendation from the CBO to make the budget whole is to have a 25% reduction potentially a few years from now, but in the benefit. So this is bad news, and what it really tells us is that this retirement savings issue really is independently your own. And although Social Security may be there, it really isn't dependable. So if retirement savings and putting away money seems like it's unattainable, I promise you it is. And you need to work with someone to make sure that you understand what you need to do, because honestly, if you don't take care of yourself, it's likely that there won't be anything there for you, or at least what we thought was going to be there for us. So now on to the good news. In terms of target date funds and investing, so the last pandemic we had in 2008, there was these glide path or target date funds, which most retirement plans have. And the performance of those funds really wasn't all that great. And people went in and out of all types of investments, which really can harm you in the midst of a down market. So this time, the average investor switched their allocation about 4% of the time. So what that means is it's down significantly from 2008. So not a lot of moves means not a lot of negative impacts to retirement accounts. But if you were in a target date fund, less than 1% of the time, people switched out of those funds. So we know one of the hallmarks of investing is staying the course and not making sudden knee-jerk reactions to a down market, which we saw particularly in this case, the quickest rebound we've ever had in history. So if you were in a target date fund, it's likely, less than 1% of the time, that you didn't harm yourself and you are on a swell glide path to retirement. So Mark, now I'm going to turn it over to you to talk about something that we never thought would be hot and exciting, but bond funds and also fiduciary liability insurance, which is also becoming something that everybody is talking about.
That's right, Rich. The first subject we're going to go over is mutual fund data and inflows and outflows. So the good news is we've got 6 months now going straight where more money has poured into mutual funds or ETFs than has come out. In fact, actually, a lot of money actually leaving money market funds, $223 billion left money market funds in Q3. Part of that probably is because yields right now in money markets are extremely low. So there's not a lot of interest or way to really earn a lot of return in money market funds. Bond funds happen to be the hottest investment right now. They've had $202 billion come in Q3. So obviously a huge quarter for them. In a historic quarter for U.S. equities, unfortunately not in a great way. It was $119 billion leaving U.S. equity funds. So that was a record for Q3. So you can get a sense of what the optimism or lack thereof is out there. But the good news is people are investing and thinking of the future. Moving to another topic, fiduciary liability insurance. So this is a coverage that's optional for all plan sponsors to consider. They can acquire an additional insurance policy that helps cover their fiduciary responsibility and gives them some backstop if there are ever some issues, with running their investment plan. Well, the litigation against plan sponsors has jumped over the years. In fact, they're now averaging like 3 to 5 cases a week that are coming against plan fiduciaries of 401ks, which has resulted in insurance plan premiums going up by 35%. Not only that, but the coverage limits are lower, which means a lot of people now have to get more policies to get appropriate coverage in place. And a lot of times the retention, that amount of money that would have to come out of the company's pocket prior to the insurance policy kicking in to cover claims has gone up, in some cases up to as high as $2 million. So if this gives you any indication on where fiduciary matters are currently sitting, it's still a very hot topic, and obviously 401ks are something still under the microscope, and obviously that's why it's important to continue to have a really sharp eye on your 401k plan.
That's great stuff, Mark. And really, it dovetails with what I was talking about with the CBO. The retirement plan is really going to be the exclusive vehicle that people use as their retirement savings. So there's going to be a lot more focus on it. And as a result, probably a lot more litigation. So thanks so much for that. And thank you, everybody, for tuning in to our Fiduciary Friday. There's a lot of great content we have throughout the week. We had a few weeks ago our fiduciary training. So we recorded that. If anybody would like to check that out, it was really well received. Please reach out to us. We'd be happy to send you a copy of that. We'll see you next week, and have a great weekend.